Hello, my name is Richard with SoCal Warehouse, and in this video today, I'm going to share with you when you may want to refinance your commercial real estate property, what you can expect, why you should refinance, and things to avoid and things to prepare so you have a successful refinance of your commercial real estate. So there really are two reasons why you would want to refinance your commercial real estate. The first and foremost obvious one is that your loan is coming due. Okay, so this is the first one. If you own commercial real estate, you are already aware that loan terms in commercial real estate are generally from 5 to 7 years. Okay, and if you don't own commercial real estate and you're planning on getting debt on commercial real estate, you can expect that a lender will give you terms anywhere from that 5 to 7 year range, meaning that every 5 to 7 years your loan is coming due, right? There's a balloon at the end of the loan, and you need to either refinance the property, sell the property, or pay off the loan. Okay, so those are your options when you have a loan coming due. So refinancing is very relevant when your loan is coming due, and you want to prepare. If your loan is coming due, you want to plan ahead. That's really the second point here, is start early if this is your scenario right now, because you don't want to be at the mercy of one bank giving you single terms, and you just have to take it because timing, right? Timing is against your side. So I always recommend starting a year in advance, starting to understand having conversations with multiple banks to get different terms so that they're more favorable for your specific scenario. One thing to know, obviously, is going to be the interest rates. You want to know what the market is doing as it pertains to interest rates, because if you have a 4% right now on your loan and it's coming due and the market is at a 6% interest rate, well, there's a delta there, and it's going to affect your debt service. And that leads me to very critical part of knowing the terms of your loan when you're thinking of refinancing, because the lender is going to have what is called a debt service coverage ratio. And essentially what this means is that the bank wants to see a margin between what you have as operating expenses and debt against your income on that property. They want to see that there's about a 25% margin, meaning that there's a delta of 25% between how much money you're making on that property and how much you have as in expenses, including your debt service. And there's a simple formula here. The debt service coverage ratio here is calculated by your net operating income divided by your yearly debt service. Okay, so net operating income, let's run a perfect example right now. Let's say that the property you had was generating $100,000 and your operating expenses are $25,000. That puts you at a net operating income, NOI, would be $75,000. Okay, you would have to get your debt service coverage ratio, you would need you divide that by the yearly debt service. In this scenario, let's say that it's $60,000, your new debt service with the new interest rate that you're going to be getting. So all we have to do is simply divide the net operating income of $75,000 divided by $60,000. And in this case, it's literally 1.25. And that's what the lender wants to see in this scenario. Some lenders are okay with some lenders have a higher, more of a requirement for the debt service to be at a 1.35, meaning it's harder to qualify. So in this scenario, the debt service is literally 1.25%. 1.25, meaning you could get a successful loan with these numbers, but you won't know until you calculate this, and you don't want to wait till the last minute to figure this out because your loan is coming due. Okay, so that's one reason. That's the first reason when you would want to refinance your commercial real estate property. Very common. Plan ahead. Reach out to us if you would like to run some numbers on your current loan and new options for a new loan that we could provide you some resources to, and we could run these numbers for you to make sure you have a successful refinance before your loan comes due. The second reason is you want to cash out. You want to cash out. And you want to pull some money out of your property so that you could do whatever your heart desires, to say the least. Some examples may be some capex on your property. Maybe you want to pull out some money to upgrade the roof, upgrade the plumbing, any wear and tear or maintenance that you have already planned to do at your property, but you want to use the equity inside of the property to finance that. So that's one reason. Another is to reinvest. Maybe you want to buy another property and pull some money out of your existing commercial real estate, and you want to do that through a refinance. The beautiful thing about refinances, if you're pulling money out, if you're not already aware of, is that that money is tax free. I'm gonna pause there. That money is tax free. You may be asking how's it tax free? Well, it's quite simple. It's not earned income. You didn't earn that income. It's debt, and you're just getting it in the form of liquid cash. Okay, so that's how it's tax free. But that is the second reason you would want to refinance your commercial real estate, is to pull money out, is to cash out. And a couple things you want to know, very similar to the first scenario, is you want to know the terms. You want to know what type of interest rate you're going to be getting on the new loan. You want to know what's the duration of the loan term, whether it's a 5, 7, 3 year. You want to know these things so that you could prepare to have a successful refinance, and you're not stuck in a bad loan just because you wanted to pull money out, right? You want to make sure that your income, the income that the property is currently generating, is at its highest possible capacity, so that you could get a higher NOI. You want a higher NOI because that's going to not only increase the value of the property, but it's going to increase what a lender is willing to let you borrow against that property. So you could do this by making sure that your leases are up to market rate. You could do this by making sure that you have solid leases in place, and this is another reason why you want to have a good resource, a good broker to give you the insight on what the market is doing as it pertains to the lease terms. As I mentioned, that cash out is tax free. And what I always recommend, if you are reinvesting this capital, you want to make sure that the interest, that the return on that next investment is going to yield a higher return than your interest rate, because that would put you in a positive leverage situation, meaning that you pulled money out, you took new debt, but your new purchase, your new debt is actually covering the return of the new property, is actually covering the delta, right? There's a margin, meaning that you're using other people's money and you're using it in a way that it's helping you create higher returns and helping you ultimately create higher net worth. Generational wealth is what they call it. But these are two reasons why you would want to consider refinancing your commercial real estate property. If you have any questions, or if you want to run some scenarios, like I said, with your existing loan, or want to get some quotes for a commercial real estate loan, do not hesitate to reach out. We're here to be a resource. You can reach us via email at info@socalwarehouse.com. Again, that is info@socalwarehouse.com. And if you want to just leave a comment wherever you're watching this video, we'll also respond. Talk soon.